Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. With new regulatory landscapes taking shape, mainly in the United States, but also across the global banking universe, how are financials poised to perform over the next few years? As the lack of recession provided a bit of a bolster to the valuation story for financials, and just how much consolidation could be on the books, not only for US banks, but also perhaps their European brethren. Joining us in studio today to help paint this picture is Fidelity Co-Portfolio Manager and Senior Equity Analyst Lee Sotos and Fidelity Equity Research Analyst Thomas Goldthorpe. Warm welcome to you both. How are you?
Good to see you.
Happy Friday to everyone here today. Lee, if we could begin, if you don't mind, with the bank earnings story from the US. We've seen some big bank earnings. When we spoke, I don't know, a week ago or so, you were expecting them to be pretty good. They meet your expectations?
Yeah, I think overall, when you look at what the banks have been printing, it's really a very encouraging quarter. We started with a tremendous amount of uncertainty, particularly in the US and on a global basis.
Second quarter was basically April 1st, April 2nd.
Right.
Yeah, okay.
So, and what we've been seeing is, I think you could have ascertained that there was going to be solid capital markets, but we've also seen investment banking starting to pick up, which was a bit unexpected if you turn the clock back 2 or 3 months ago. In addition, banks saw very good loan and deposit growth in the quarter. Now, you might there are some questions of the sustainability. A lot of that is inventory build and working capital, but the outlooks have generally been pretty positive for back half loan growth. So, I think the U.S. consumer looks healthy. Office has been kind of one of the things that's stuck out the last couple of years, and it seems to be kind of muddling through. And businesses in general are pretty healthy. So we really remain pretty constructive on the U.S. Earnings numbers are going up, not down.
Yeah. I mean, just quickly on the consumer, we had retail sales out in the US. I mean, people are still spending. It's sort of surprising. It still makes you want to ask if the next shoe is going to fall. But just your general thoughts on what it appears banks are doing in the US. Just follow up to what Lee said.
Yeah, so I think it's just generally business as usual. So right. I think as you saw through the quarter, I think loan volumes picked up as the quarter progressed. There's still strong, underlying reasonably strong business fundamentals within the U.S. from whether it's the data center build-out, whether it's the reshoring, and generally slightly more certainty comes to market, whether it's the big beautiful bill on tariffs. There's theoretically more certainty coming, then you're starting to see people come back to work.
Okay.
And I think that's at least putting some level of economic activity into the U.S. economy.
And certainly a floor. We'll talk more about deregulation as well and what that means ultimately for the financials. It means a lot for the financials. Wouldn't mind your thoughts on the discussions about Jerome Powell right now, Fed independency, really as it goes to investors taking a look at whether they need to have a premium on paying. Do yields go up essentially because there's uncertainty about whether there is Fed independence? That's really more the question from an investor perspective.
Well, I think what we have seen so far is, there's a confluence of tariffs and rates. And so, and there's different interpretations as to what tariffs actually do. There are interpretations that tariffs are inherently inflationary, at least in the short term. And so Jerome Powell has taken the view, or sort of settled in with that view. There are other views that tariffs are a tax and will ultimately cause a slowdown in the economy. And so I think there's various viewpoints, but there's also political pressure on him taking the view that that tariffs would cause a slowdown. I think to date he's done a very good job navigating what has been a difficult political environment. But there's we go tweet to tweet. But I think ultimately the view is that President Trump will continue to listen to his advisors, and while he may continue to job on the Fed, will ultimately wait until year end to really move. But certainly there is a risk that he would move faster, and I think that would probably not be positive for long-term rates. I think long-term rates would be at risk.
That's where you'd sort of see it expressed in the currency as well. Is there any thoughts on that? I mean, we're all watching this unfold. Is there any, from the investment perspective, investor perspective, what do they have to kind of worry about, if anything?
I guess it's just continued thought about what does higher for longer rates potentially mean?
Right.
And how do customers react? How does the housing market react? And does that have any kind of negative consequences for the consumer? And then also how it flows through bank earnings, because obviously there's some puts and takes that need to be considered, right, in any investment decision. Yeah.
So when you take a look at the conversations that we're having around whether there is or isn't a recession, it sounds like the picture that was painted from the bank earnings and what you think generally, the recession risk is on the side. Doesn't mean anything's ever diminished. What's it mean for the valuation story for some of the U.S. banks? We'll start there.
Well, I think we've taken away some of the tail risk. I mean, there's always some probability of a recession, and we still don't know what the ultimate impact of tariffs will be. And obviously, the level of tariffs has some impact on that. Taking that aside, the outlook for U.S. banks is quite constructive. I mean, the tailwinds that we've discussed in the past, deregulation is real. You have a new head of supervision who has been so far quite aggressive in moving things forward. So we're very optimistic about that. And there's various parts of deregulation. And I would call it more re-regulation as opposed to deregulation, because it's not just a gift to the banks. It's more getting regulation right. In addition, you still have 4,000 banks in the United States, 1,000 that are publicly traded. This administration seems to be a little more pro allowing the banks to consolidate, which I think is needed in the United States. It's the least consolidated banking industry on the planet. And finally, you have a rate scenario right now, which has been fairly stable for a period of time, which continues to sort of support bank earnings.
Okay, that's fascinating. And the deals that you were talking about, the potential consolidation that's there, Thomas, we'll just ask you to comment. I mean, there are deals happening. It's pretty much every day. It seems to be quite a pipeline at this moment. I mean, even outside of the banks. But what about the banks themselves?
For sure, yeah. Like we've definitely seen a lot of deals, and the deals make a lot of sense, right? Because I think everyone's trying to gain scale, and the big things on scale is as the world gets more digital, there's more benefits to scale there. There's more benefits from scale on AI implementation. With increased regulatory focus, there's more benefits from scale to that as well. And I think you're seeing in some of the larger players like at JP Morgan, they're really pressing that scale advantage versus some of the regionals. And the natural response to that is we need to get bigger. And the interesting setup now is you have a more accommodative regulatory framework that looks more favorably on M&A. You're starting to see a wider valuation gap between the regional banks and the large banks, because the regional banks used to trade at a premium to the large banks. Now they trade at a discount. So there's more room to pay a premium and get like accretion on valuation metrics. And then just intuitively, you're seeing the more willingness both on a strategic basis that an openness that, we need to get bigger, we need to gain this scale, and this is how we're going to compete. So you're seeing that progress, and you're even seeing it this week. We've seen a larger deal earlier this week, smaller deal today. So these deals just continue to happen. And obviously with 4,000 banks and 1,000 publicly listed ones, there's
it's
a
sort
long
of eye-watering
runway.
when you
there's
think
a long
about
runway.
1,000 publicly listed and then another 3,000.
And it's just, where the world's going. When you think about any of these trends, it's going to favor the larger guys, right?
Will it always be a case of consolidation? Will some of those many thousand banks continue to exist, as you say, as the world becomes more digital? I mean, or will the customers just migrate elsewhere? Are they all good deals to be gobbled up, I guess is the question.
Well, of course, there's always bad banks
out there. There's good banks and bad banks,
I mean, and everything for a price. I mean, as a shareholder of banks, you certainly don't want a bank you own to overpay. So, there's good banks and good deals and bad deals. And part of that is financial, part of that is strategic. There's lots of deals or, sort of speculated deals out there that make a lot of strategic sense.
And do you see those moving quite quickly once deregulation or re-regulation actually lands? I mean, the big beautiful bill has gone through, the promises are there, we seem to know that it's coming. Tell us a little bit about the logistics of this rollout.
Yeah, so as we've discussed, I mean, one of the issues we still have from a regulatory standpoint is the previous, sort of Fed regime. The regulators really took a view on process over safety and soundness. And in doing so, they rated the banks, and all the banks have various ratings, and 2/3 of the top 50 banks were rated as not well managed. And that could be small idiosyncratic processes that the regulators didn't like. The current supervisor has put out sort of guidance for the regulators, and that needs to be codified still, which will more focus on safety and soundness, liquidity, and things like that, the things that actually matter to the system. Once you have the re-ratings, I think a number of the banks will fall off the not well managed.
That must have made them cross.
Yes,
to be called not well managed.
Yes, you're talking about a lot of big sophisticated banks that are well managed and have a ton of liquidity, plenty of capital, managed their credit very well, but it became so process oriented that it kind of fell, the other way. So I think a lot of the banks are just waiting for this re-rating to happen before they move.
Timeline? Rough timeline?
Back half of this year, maybe we start to see some bigger deals. I think it's, we're probably, the changes that would be made from the supervisor do not have to go through a huge process.
Okay.
It's really sort of a change in guidelines, and it's for comment right now, but it could be implemented fairly quickly.
Lending looks good, actually. This should benefit lots of smaller companies, big companies too, but maybe companies that haven't had as much access. Rates have come down to an extent. We now don't know where they're going to go from here, really. Well, in Canada, they're actually pretty low. But just talk a little bit about the lending environment. What's shifted over the last year, probably?
Yeah, so I think big picture. So there's still some uncertainty out there for sure. I think there's still some hesitancy to truly go all in on large new investment. But at the same time, there has been arguably an increase in certainty over the last 3 to 6 months, like especially compared to a year ago. Now you have the election is out of the way.
It is in Canada, yeah.
In
the US.
Okay, in Canada, yeah.
We can do both, and then we'll.
Yeah. So I think looking at it from a Canadian standpoint, loan growth, the here now loan growth still remains relatively muted.
Yeah.
But the thinking is on the commercial side, again, you're getting a little more certainty. It's the same thematic. So now you have an idea of the Prime Minister, you're getting a better sense of the regulatory framework, maybe a little more pro-business. So there is some indication of, and then a little more certainty around tariffs. especially with the Kuzma carve-out. So there is a little more certainty than there was a few months ago. So obviously, commercial demand was anemic at the bottom of the trough in April. Now that has rebounded, but still below trend levels. But there's some indications with the pipeline build and recent conversations that should improve. And the thing there is people are still doing the same day-to-day work. Day-to-day banking continues. They're completing existing projects. They're still having a difficult time starting new projects because they just want a little more certainty. And on the consumer side, again, consumer has been relatively muted. The housing market's slow. And yeah, what you're seeing is just consumer behavior changes. Right. So as the inflation kicks in, as unemployment picks up a bit, as various other factors come in, and as rates are resetting on mortgages, consumers have adjusted spending behaviors. Yes. So they have taken down their discretionary spending. They're less willing to take out the big loan to buy some big discretionary purchase. So they're retrenching, which has held up loan growth. Though still positive, but it's at kind of below trend levels right now.
I wanted to ask you about investment banking, but anything to add to loans quickly there as sort of a broad statement? Do you cover it most?
I think in the U.S. There was really a dearth of lending for a period of time, and what we're seeing is the consumer continues to borrow off credit card, which it's fine. That had been the engine of growth for U.S. loan growth for the last couple of quarters. Now we're starting to see some commercial lending. Some of that we'll see. I think the positive, so the skeptical side would say it was just building inventories and was uncertainty focused. But when you listen to the banks, they are starting to see, again, small businesses and middle market businesses are dealing with the uncertainty and starting to move again and starting to invest in their factories and et cetera. So you are starting to see some core loan growth, which is investment related. And then another area of loan growth that has been relatively low is just around deal making and advisory. You were going to ask about investment banking.
Let's go there. Yeah.
It has picked up on a year-over-year basis. Pipelines are quite healthy, and I think the one area where we have not seen much activity is out of the sponsors or sort of the private equity firms. But now, as markets are at all-time highs again and pushing higher, that's an area where we believe that you could see increased activity. And it's starting to bear some fruit. I mean, we had a much better IPO market in the second quarter than expected. Much better. And so you're definitely starting to see the various areas of capital markets and investment banking get some traction where they haven't for a number of years.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connect's, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
It's really interesting. I'll ask a little bit about the regulatory story within Canada specifically. It's been much more noteworthy in the US because of the One Big Beautiful Bill. But things here have sort of incrementally become more and more and more regulated for quite some time now. We hear that that's tapering off. How would you describe that now?
Yeah. I think that's a fair take. So simple story is post-GFC, there was a big regulatory push to increase capital levels at the banks. You saw kind of consistently increasing capital levels at the banks for arguably the last 15 years, right? From 2010 to maybe 2024. And effectively what higher capital does is, one, it lowers your free cash flow conversion because you have to actually reinvest in your business to increase the capital levels, and it also lowers your return because you have to hold more capital versus your loans. Subsequent to that, starting maybe 6 to 12 months ago, is the regulators were initially wanted to be very proactive on the implementation of Basel III. They saw the rest of the world had actually slowed down that implementation. Yeah. And they decided to say, hey, if everyone else is slowing down, we're going to slow down as well. And now you're in a position, which we haven't been in for a very long time, where the capital rules aren't getting worse. So they're not necessarily getting better, but they aren't getting worse. And we just
that can mean a lot in valuation.
Right, and we just we just went through a period here where things got worse in the capital for 14 years in a row.
Right.
So things aren't getting worse, and there is a greater openness and acceptingness from OFSI in their public statements that they have to consider their capital rules in regards to where the rest of the world is to ensure the global competitiveness of Canadian banks. And these are the types of things that they were not talking about a year ago and wouldn't even consider. And now they're talking about it, and they're talking to the banks about it. So the probable scenario is you don't get loosening, but you just don't get things getting worse. And that actually is a big incremental change from where we have been for literally 15 years.
It was an era, literally, and it's perhaps slowed. So here comes the question that I was going to ask you. We will swing back to sort of the global look at banks in just a minute, but this question coming in, could the emergence of crypto deregulation impact banks, the industry? This is something we were speaking about off air. Stablecoins are everywhere. The discussion, the Genius Act, we know it's all there. I guess the question for you is, how do financial institutions either cotton on to this or put it on the side or make sure that they have avenues for it within? I'll ask you firstly.
So, yes, it is certainly a topic of conversation, actually. It comes up on every bank conference call now. So certainly the banks are aware of it. And banks historically have been very adaptive to new technologies and taken on new technologies themselves. When we talk about stablecoins, the use cases for stablecoins tend to be probably most applicable to cross-border payments. When you think about domestic payments, a lot of what stablecoins can offer is already within the banking system. And
is it already within the dollar?
You can already do tokenized deposits, which are currency-backed, obviously. So you have tokenized deposits, you have money markets, which have a very similar function of moving money around. At this point, stablecoins they're not paying interest, they don't pay rewards. So when people talk about disrupting kind of the credit cards or those type of payments as well. Another thing is when you think of stablecoins, so let's say Amazon does a stablecoin. Well, that stablecoin pretty much sits within the Amazon ecosystem. Mm-hmm. I think Thomas had called it something like a gift card. So if Apple does a stablecoin, again, it sits within their ecosystem. There have been some questions about whether the banks would consider a consortium to do a banking stablecoin. Right now, you have JP Morgan has done a stablecoin, B of A is talking about it, Citi is doing it, but the banks have often acted in a consortium, kind of like Zelle as a payments rail. So it's always possible that the banks themselves kind of come up with a banking stablecoin in and of itself. So again, you kind of go back to cross-border, and that really, where you would see an emphasis is just on the inefficiencies of the SWIFT system for international wire transfers and moving money. But outside of that, it's really hard to see sort of massive disruption within the banking system.
Okay, really. Anything to add to that? I mean, you hear about it in Canada. We talk about it in Canada. It's obviously a big week in the U.S. for the discussion of everything crypto and stable coins. But what about the Canadian story?
Yeah, I think it's similar story in that part of the crypto story is regulatory arbitrage. As it gets brought into the more formal economy, that will come with some regulation. Therefore, they're less advantaged once you have to put regulation on top of it. I agree with Lee that the banks are flexible, so the banks will adjust. And the truth is, it just incrementally increases competition in the banking system, and it'll put more pressure on fees, right? So we've seen the same trends over the last 20 years, of fees slowly ticking down.
Bank fees come down.
Bank fees coming down. And that will continue on a go-forward basis. And then within a Canadian context, a lot of the banking innovation, a lot of the fee pressure, all that stuff, it generally lags the U.S. Because we're more enclosed economy. So I think that will also follow. Those same trends will occur in Canada as well, just will occur with a lag.
Okay, really, really interesting. Let's ask you, Lee, a little bit about positioning, what you like. You do go around the world a bit. I know insurance has been a focus in the past.
Yes.
Give us some broad strokes on the positioning that you have in the fund right now.
Yeah, I mean, I think one thing to highlight is it is a financials fund and not just a bank fund. So, and as we've discussed in the past, one of the things we've tried to do is to have some balance as far as interest rates go. And as I've mentioned, if 10-year traders can't get it right, then we're pretty much sure we can't. So we have a number of names that benefit if interest rates stay higher for longer. We also have a number of names that would benefit in a lower interest rate environment.
So you're rates agnostic to an extent.
Yes, it's actually one of the least contributing factors to performance within the fund. And so, if rates do come back down, we would expect a lot of our capital markets names to do well. There's also other areas that would do well. We have some alts or private equity, as well as private credit funds would do well, or private equity firms and private credit firms. But I think the important thing to think of is, again, it's not just a bank funding. You can get interest income out of very different sources. Right. So some of our most asset-sensitive names are actually investment platforms. Not the banks, but the investment platforms. So we look at, one of the things we've done is looked at all the fundamental factors that drive the portfolio. And we try to really accentuate the different factors themselves, as opposed to we need a bank because we need more interest income. Well, we can get that lots of different places. So, when you look at it, we still are pretty rates agnostic. I think we've talked in the past, we still favor growth areas like Asia. Mm-hmm. We still favor themes like wealth management and trading platforms. And when we look at Europe, we have been underweight European banks, but overweight European insurance. Right. And probably the biggest shift we've made, which is not a huge shift, is we've shifted a little bit of our U.S. exposure from the larger banks to the regional banks, just because they've, as Thomas had mentioned, they have lagged so much. We've moved a little bit more there. But outside of that, not a lot of changes.
That's fascinating. And we just have a few seconds here, but I might just sort of a quick case for the Canadian banks at this stage. And maybe it's just a neutral discussion, but what do you think the banks have ahead in Canada?
Yeah. So the banks, it's we're in an interesting period for the banks, right? So with both positives and negatives, right? So the positives are very much credit remains at above normalized levels. That will ultimately return to normalized levels. When that occurs, that gives you some excess earnings growth. So you should see above normalized earnings growth in the coming years. You also have this regulatory angle, which instead of having to hoard capital every year, now you don't need to do that, and that will lead to higher share buybacks, right? And then just in general, the banks are well run. They're not they're better capital allocators than they have been kind of on a historic basis. On the flip side, a lot of this is already being priced in, given that we're at peak valuation multiples, and there's still non-zero economic risk within the Canadian economy. Base case remains that we muddle through, it'll be fine, but there's still risk out there, whether it's tariffs, whether it's the housing market, whether it's other stuff going on. Unemployment continues to go up. There's other stuff to keep an eye on, right? So at this point, there may not be a clear, because there's times when there's big macro directional trades to be made, and there's times when you can focus on stock picking. And this is more of a time for stock picking. And generally, as a group, we've done a good job of really staying top of all the banks, not just the ones that have done well, really understanding the core drivers of those banks, and really trying to take advantage of disconnects, because you do get these, especially in this market.
This year has been,
like in this market, every 2 months you have a different thematic. It's like, oh, there's a tariff winner, there's a tariff loser, this is the US, we want Canada, we want housing, we want consumer, whatever. And you get these really big disconnects on valuation, and the banks are notoriously mean reverting. So there is a lot of contrarian opportunities to be had
by, it's been an interesting few months that way.
By finding like real disconnects. And the great thing with us is we don't have to worry about what's going to happen next month, or what's going to happen in earnings, or it's too early in this thematic, or momentum, or they're going to shut me down. Is we can take that longer term view.
That's perfect. Well, we'll have to leave it there. Sorry, we'll leave it there. Thomas and Lee, thank you. I hope you have a great weekend ahead. And thank you for spending your Friday with us talking about the global financial picture.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.